Hi everyone, I'm Roger Montgomery from Montgomery Investment Management and welcome back. Today we're examining record stock markets, what's driving them to record highs, the risks of a pullback and how you can protect yourself if it all comes undone. The S&P 500 is trading at historic highs. Metrics like price to earnings, price to book and market cap to gross value added, the latter being a price to revenue ratio for non-financial stocks in the US, are in uncharted territory. According to John Hussman from Hussman Funds in the US, and as this chart shows, US non-financial market valuations now exceed both the 1929 and 2000 peaks. Of course, high valuations don't guarantee a crash, but they do signal low future returns. As this next regression analysis chart shows, current valuations predict a negative 6% annualised return for the S&P 500 over the next 12 years. That's compellingly unattractive. Vanguard has also produced a forecast using their capital markets model and has recently revealed a slightly more palatable 3.3 to 5.3% forecast return for equities over the next decade. For growth stocks, Vanguard reckons returns over the next decade will be no better than 1.9 to 3.9% annualised and volatility would be above 16%. Is that enough? Would you be happy investing in high growth equities if you knew the best you could achieve on average over the next 10 or 12 years is minus 6 to 3.9% per year, and there could be years where the market falls by 16%? Or what if you knew it might fall as much as prior episodes, by 20, 30, or even 50%? The AI boom is the big driver of all the returns to date. Investors are pouring money into tech giants, expecting massive growth. And those global AI players are spending that money with gay abandon. According to the Gartner Group and Deloitte, AI spending is expected to reach $1.5 trillion in 2025, with $650 billion of that allocated to infrastructure, including cloud and semiconductors. But there's a catch. AI sales revenue was only $4 billion in 2024, and clearly it was dwarfed by investment costs. Sure, it's expected to grow this year and next, but so is the infrastructure spending. Will stock market investors collectively, patiently wait until all the investing is done? Will they wait to see if a decent ROI can be produced? Investors are notoriously impatient. It's also worth remembering the way bubbles build. First, the best stocks are bought, then those that are left behind because they look relatively cheap. Eventually though, every stock is priced as if they will all win. But capitalism rarely, if ever, lets everyone win. Not every AI company can win, yet they're all priced like champions. Some argue markets won't crash because passive investing and cash inflows keep pushing prices up. That's the weight of money argument. Superannuation flows in Australia haven't protected the stock market from crashes before. The weight of money argument is a flawed one. Bubbles form when expected returns keep rising with prices instead of falling as prices go up. In 1929, economist Irving Fisher famously predicted, quote, a permanently high plateau just before a 90% crash. Today's optimism mirrors that era. A bubble bursts when investors realise high prices lock in low returns. If growth slows, someone will blink and the dam wall will break. Now, I'm not suggesting you should bet on a crash. What I am suggesting is don't ignore the risk. In recent years, investors have earned stock market-like returns without stock market volatility. I know of a private credit fund that has been running for 8 years, has returned 9.5% per annum, has never had a negative month, and has no stock market exposure. I know of another alternative fund, an arbitrage fund, whose investors have experienced one negative month in its 52 months. They've enjoyed returns of more than 20% per annum and again have had no stock market exposure. Of course, it's vital to point out that past returns are not a reliable guide to future returns. And that warning is also true for the stock market. Recent returns aren't a reliable guide to future returns there either. Rebalancing your portfolio is going to be key. Trimming potential overpriced equities to reduce exposure and consider uncorrelated alternatives is going to be essential, especially if you're retired or retiring and can ill afford another big market setback. Well, that's it for today. Markets are pricey, but there are methods and alternatives that could reinforce your portfolio and protect your lifestyle. I look forward to seeing you again next week, and in the meantime, follow us on Facebook and X, and at our blog, rogermontgomery.com, where we post up to twice a day.